everyone, welcome back to Tasha's Takes at Money 2020 here in Las Vegas. I am very honored to be chatting with Alex Johnson, the founder of Fintech Takes, about open banking, which if you read his newsletter is something that he has written a lot about and has written very knowledgeably about. So I'm hoping to get a little bit of that information out of him and learn some stuff about 1033 as well.
Yes.
So thank you for joining me.
I am delighted. Thank you for the invitation.
Yeah. So I want to start with ownership of data.
Yeah.
So just a bank and a consumer who banks with that bank, who actually owns that data? Who owns the customer data, the transactional data? Is it the bank or is it the customer?
So it's interesting because legally, technically, it's the bank's data. However, you don't make a lot of friends anywhere in the world by saying it's our data, not the customer's data. And what I've realized, one of the things I've realized about open banking is just saying it's the customer's data, they can do what they want, it unlocks a lot of doors because you can't be on the other side of that going well, actually, technically it's not the customer's data, it's our data and we don't want them sharing it this way. And so I think a lot of the growth that's happened in open banking over the last 10, 15 years in the US has really been built on this idea that banks don't really want to share the data. Technically, legally, it's their data, but the consumer under 1033, Dodd-Frank, has the right to share it. And no one wants to argue, not even the banks, that it's their data and not the customer's data. And so I would say, rhetorically, it's the customer's data. And that really is all that matters at the end of the day because the customer wants it. The customer, your customer, is telling you, I want to share it in order to get access to these other services. And we've even seen some emerging evidence that if a bank is too sort of rigorous in the way that they stop consumers from sharing their data, that the consumer will consider switching banks, right? And so it is a competitive risk to a degree if you're a bank that takes too hard a line on this. And so that's generally been how the market has evolved.
That's really interesting. And so before Plaid, before aggregators, the only way for customers to actually get this data was then through bank statements and looking online and copying it over to a spreadsheet or something like that.
Yeah, I mean the classic example is mortgage lending, right? Where it's if you're going to get a mortgage, one of the things that a lot of lenders would require you to do is okay, show me the last 12 months of bank statements. And so you'd literally print them off, you'd put them in a shoebox, you'd take them down to the branch. That was open banking in an analog sense. And what we've just done in a lot of senses is digitize that process. But in digitizing that process, we've unlocked a bunch of capabilities that we didn't have before, because obviously that's inconvenient, that's not intelligent, that's time-consuming for the loan officer to go through. There's all kinds of problems with it. And we have also waded into new kind of legal and regulatory territory, right? One of the examples of that is with the shoebox argument. That was always the idea that Plaid in the early days would talk about when they were saying, we shouldn't be regulated under FCRA, we shouldn't be considered a credit bureau, because really, we're just dumb pipes that are just passing data along, just like the digital version of someone taking statements in a shoebox. That is not actually true, and Plaid eventually gave up that argument and sort of switched their view, and now, of course, they are a consumer reporting agency, they are functionally acting as a new school credit bureau, they're doing a bunch of stuff in cash flow. So when you digitize something, it moves you into different realms from a regulatory perspective, from an operational risk perspective, and in a lot of ways, that's what we've been kind of wrestling with as an industry over the last 5 or so years, is as this happens at scale, now we have other considerations.
Okay, so in that sense then, when Plaid came along and they digitized this shoebox, how did they do that at the time? So screen scraping, how did that work? And how were they able to manage that?
Yeah, so screen scraping is the tool of the disruptor trying to disrupt the incumbents, right? And so, again, it all flows from consumer permission. So you say, rhetorically, well, it's the consumer's data, so they can share it with whoever they want, including they can share their login information, their username and their password. And if they give you that information, then it's trivially easy from a technology perspective to build a bot that will take those credentials and use them to access the data as if they were the consumer. Now, screen scraping has all kinds of problems, right? You really don't want your customers sharing their username and password. That's just generally a bad practice. You don't want that data to be sent out into the larger universe. And from a performance perspective, this is not the way that we transmit data efficiently, right? And so banks, once they see enough of this activity at scale, they start to see sort of degradation of the performance of their digital banking systems. When they change something in their digital banking platform, it breaks a screen scraper, and then suddenly the consumer's connection breaks. So screen scraping is not secure, it's not performant, it's really not the right way to do it, but when you're Plaid and you're a brand new company, or you're Yodlee, or you're MX, or whomever, the banks don't want to play ball with you. They don't want to stand up an API for you. And at the time, there was no regulation requiring them to do that. And so screen scraping became the way that they generated enough volume and had enough of those banks' customers to say, look, we're going to do this whether you want us to or not. It's better if you stand up an API and we sign a bilateral data access agreement so that at least we can do it in a safe, secure way that gives you some governance and some oversight over that process. So that really started to happen circa 2018, and that kind of led us to where we are right now.
And so right now, Section 1033,
yes.
Where are we? What happened? What is the status today?
Yeah, so Section 1033 is very short. It's this tiny little passage tucked inside the Dodd-Frank Wall Street Reform Bill, which was the largest piece of financial services regulation ever passed by Congress, right? So tiny little passage tucked inside there, very obscure. And what it says functionally is that the consumer doesn't own the data. That doesn't say that, but it does say the consumer has the right to share their data and to do so with authorized third parties. And there have been some fights over all the words in that statute, including the term authorized third parties. But fundamentally, 1033, as envisioned by Congress, was the idea that we could create more competition among financial services providers if it was easy for people to port their data over from one provider to another. The classic kind of go-to example outside of financial services is the telecommunications space, right? So it's a lot harder and more annoying and more risky to change from Verizon to AT&T if you can't take your phone number with you. But now that you can take your phone number with you, it's much easier. And what that does is it pits Verizon and AT&T against each other in a much more real way to my benefit as a consumer. Yeah. So incumbents don't like this kind of stuff, but regulators who want good outcomes for consumers, lower prices, more competition, they like it. So that was the intent behind 1033. Again, Wall Street Reform Act passed in 2010. So it took a while for regulators, the CFPB specifically, to get to open banking. And to a degree, that's understandable, right? Because they were trying to fix the mortgage market. They had a bunch of other fish to fry, some of which was mandated from a timing perspective to go first. But when they got to, again, circa 2018, roughly, that's when the CFPB started really kind of working on it. All of this crested with the finalization of a new rule, the Personal Data Access Rule, and it's built on the authority granted to the CFPB by 1033. And basically, it just operationalizes this idea that the consumer should have the right to share their data with third parties. As I'm sure everyone listening and watching knows, there's been a lot of debate and a lot of disagreement before that rule was released, and then certainly after that rule was released.
And since the new administration came in,
yes,
things changed quite a lot with this rule.
They did.
And then JP Morgan Chase came out and said, okay, aggregators, if you actually want to get this data, you can, but we're going to charge you.
Yes.
And in one of your recent newsletters, you talked about how Plaid agreed to pay JP Morgan for this data, and you kind of compared Plaid in this instance to the defector in the prisoner's dilemma, which I really liked as an analogy, and to explain to everybody watching what you meant by that, what that means, and by Plaid defecting in that way, what it kind of means for the rest of the market here. Yeah,
so what happened was Chase first, through BPI, the Bank Policy Institute, which is one of their trade associations, sued the CFPB right after the rule was finalized. And the lawsuit basically argued that the CFPB didn't have the statutory authority to create a rule like this. And what was interesting was when the new administration took over and the CFPB turned over, the CFPB basically said, yeah, we agree, actually. The CFPB doesn't have the authority to do this. This rule is not in keeping with the intent behind the statute. So we should toss it out. And you can imagine in a lawsuit when you're going before a judge, if the regulatory agency that wrote the rule is now saying, yeah, actually, this is not right, we should just throw it out, the judge isn't going to disagree with that, right? And so we were on track for 1033 to probably get thrown out by the judge and to just have it be eliminated entirely. Before that happened, though, JP Morgan Chase decided to introduce pricing for the access to their open banking APIs, and that was a strange timing decision. But when they did that, they basically gave relatively firm and high pricing to all the aggregators in the space and said, if you want access to our API, this is what you have to do. The pricing that was proposed was so high as to be unworkable by any of the providers in the space, right? Like we're talking, because Chase is a big bank, they have a lot of deposit accounts. If the aggregators had to pay Chase what Chase initially had proposed charging, it would have equaled like all the revenue they made that year. Or in some cases for smaller aggregators, all the revenue they've ever made in the entire history of their company existing. So the pricing was like ludicrously high, right? And you could call that a negotiation tactic. So Chase introduces that pricing. Because they introduced that pricing, the CFPB completely flips and says, actually, we don't want to throw out the rule. Instead, they told the court, we'd like you to pause what you're doing so that we can rewrite the rule because we think that what Chase has done here that's too far. We didn't want that to happen. So they kind of flip-flopped. But at the same time, Chase still had this pricing out there. And to go to the prisoner's dilemma idea, basically, for those not familiar with game theory, the prisoner's dilemma is a situation where two co-conspirators are put into separate jail cells, and the police go to them and say, all right, you, prisoner A, we know that you did this. If you provide evidence against your co-conspirator, you will get off with a light sentence and we'll throw the book at them. However, you should know we're giving the same deal to them, and if they flip first, they get the deal and you don't. And, oh, by the way, if neither one of you confess, then you get a moderate sentence, but not as bad as the person who gets screwed if the other person defects. So it's this very strange situation where it's in your rational best interest as an individual actor to defect, to cooperate with the authorities, even though collectively, if you hang together, both parties can get a better outcome. That, I think, accurately describes the situation that all the data aggregators found themselves when Chase plopped this pricing down in front of them. And as you said, Plaid defected. So Plaid, the largest data aggregator who had the most leverage, they agreed to pay JP Morgan Chase rather than to try to hold out with all the aggregators and maybe wait for the CFPB to write a new rule to stop this from happening, to let lawsuits play out. They decided to basically lock in that reduced sentence. And, again, from a rational perspective, they got the best deal, right? They're the largest aggregator. They got preferred pricing. They got some other concessions from Chase, where Chase is now providing a better API and better services. So they got some kind of concessions from Chase. But in so doing, they really screwed over all of the other data aggregators and even some of the large fintech companies that might directly connect to banks for data. So that is kind of where we are right now. The question is, are other data aggregators going to cooperate? And are other banks who haven't been following Chase into this but have been watching closely, are they going to jump in and now try to get pricing as well?
Okay, there's a lot here. This is so fascinating.
Yeah.
What's your best guess as why JP Morgan Chase introduced this pricing proposal when they could have just waited?
So, it's funny. I have come to realize over time that a lot of things are more personal than they appear, right? We talk about everything that happens in this industry as like the rational decisions of rational business actors. But the reality is all businesses are run by people. People get mad about stuff. And there are a set of banks, Chase is among them, PNC is among them, there's a couple others, who just don't like open banking. They have beef with specific aggregators. It just rubs them the wrong way on a number of different levels. And so I think Chase felt like it had an opportunity in that moment of uncertainty, that regulatory moment of uncertainty, to basically sort of seize control of the market and to do what they wanted to do around open banking. As I indicated before, I think they misplayed their hand a little bit, because if they had just waited a little longer, the rule would have been thrown out entirely, and I think they could have gotten a lot more out of it. But they sort of took a very aggressive public stance in doing it, and that engendered a lot of backlash from the fintech community, notably from the crypto community, and that's what sort of forced the CFPB to wade back in, even though they don't really want to on this issue. And so I think even though Chase, you could argue, got what they wanted from Plaid, they got Plaid to agree to do this pricing, now they kind of have changed the facts on the ground around pricing for open banking. They did it in a way that I think reduced their leverage and ultimately got them probably a worse deal than they could have gotten otherwise.
That's interesting. I guess we'll never know, but I wonder if they thought that by jumping in with this pricing proposal, if they had waited, then maybe the CFPB would have come forward with some sort of pricing structure or some structure that actually would have been lower price, less advantageous to them. Do you think that's what their thinking was?
What's so funny about it is the CFPB is kind of the unheralded character in this story, right? Because the CFPB is sort of two different things operating at the same time. One is a grand social experiment run by Russ Vought, who's the acting director of the CFPB, to basically see like how much federal bureaucracy he can destroy. So it's sort of like a performance art piece in a way, and that version of the CFPB, I think, was going to toss out the rule. They've fired a bunch of people. They basically gutted the CFPB in every meaningful way. I think if they just waited for Russ Vought to continue doing his thing, he would have kept doing it. However, there's this other part of the CFPB that will get activated from time to time, and that part of the CFPB is the pro-competition part of the CFPB. And so, it's really interesting. And I think the other lesson from all of this is that I think the sort of public policy lobbying space has changed in a way that banks in particular have not fully sort of appreciated. But all of this flipped. The CFPB flip-flopped on open banking, specifically, I believe, because crypto waded into it. And crypto has the ear of the White House right now. And so crypto called someone at the White House. Tyler Winklevoss famously tweeted about open banking. And it got the attention of the White House, and they then filtered down to the CFPB, hey, we love what you're doing, destroying the CFPB, but in this particular case, would you mind wading in on behalf of crypto and fintech? And that's what they did. And so the question really is, now that the CFPB has waded back in, what does that mean? Are they going to get activated in some new rulemaking fashion? We don't know right now.
Okay, very interesting. And then why would Plaid defect? Presumably because there's some competition stuff at play here.
Yeah.
They are the biggest aggregator. They've got more revenue. They've got more consumer customers. They've got more business customers.
Yeah.
If they can come in here and set a price that only they can handle, maybe they lose the competition. Is that an angle?
Well,
is there like an impending IPO angle here as well?
Well, so I think it's two parts. I think they have the margin to be able to pay for this, right? So they are paying a higher price than they were paying before. They're paying nothing, so if any price is higher. They are not, at least in the short term, passing those cost increases on to their customers. So they locked in, at least in the short term, no changes for their customers and certainty around it, right? They also, I think, do really value the fact that Chase is going to be sort of building more premium APIs that they can use that are just going to work better. I think they view that as a good thing. One of the things about open banking is banks, if they want to, can rub sand in the gears of open banking for eternity, and they will. And so getting them to agree to not do that, I think, is actually a really huge thing. And then to your point about the IPO, the fact that they are going public soon, I would imagine. And they just raised a round of funding, so they don't have to go public right away, but they'll go public at some point. When you file the paperwork to go public, one of the things that you have to disclose are risk factors to investors. And I really genuinely think Plaid didn't want this risk factor of, the costs of our raw materials may go up. Or we might get cut off from some of the raw materials we use. That's a big deal. And I think eliminating that uncertainty and that risk, particularly for a company in Plaid's position, I think that's why they did what they did.
Yeah, interesting. Okay. And so one of the things that I think about a lot in the banking as a service space is the power dynamics between banks and fintechs, because I thought between sort of 2020 and 2024, or maybe even 2023, fintechs had all the power. They could tell banks how they were going to run their fintechs. They basically got to decide. They could move between all the banks. Banks were desperate to work with fintechs. And I think in the last 12 to 18 months, we have seen this shift of banks kind of realizing that they're the ones with the one thing that the fintechs don't have, that the fintechs need, which is the banking license. And banks have been able to a little bit more forcefully say, actually, no, you need to follow these processes, you need to work with these vendors, you need to do all this stuff.
They can dictate to fintechs.
Is this open banking's version of banking as a service's, power dynamics playing out?
I think so, yeah. I mean, I think in the case of banks in banking as a service reasserting their influence over the space, that was driven by regulators cracking down on it, right? And suddenly, if you're a bank that can still take on new programs, you have more power. I think in some ways the open banking thing is kind of the opposite, where, the Biden-era CFPB was kind of the cop on the street watching to make sure no one kind of abused the rules. When they stepped away and obviously were replaced by the Trump CFPB, which is, five guys and a ham sandwich, you don't get the same cop on the street sort of vibe. And I think into that vacuum, banks basically said, and Chase in particular, we have an opportunity to assert just kind of raw market power here to get what we want and to get a better outcome. And I will note that the other thing that's interesting about Chase is Chase actually likes open banking, right? And this is an important thing for banks to understand, kind of similar to banking as a service. Chase is going to go on offense with open banking. And they already are. They're doing it for cash flow underwriting. They do pay by bank for some of their larger commercial customers. They use it for all kinds of different purposes because they're a large, smart bank that realizes hey, this is valuable to us. One of the concerns I think that you have to have if you're a smaller bank is, has all of the stuff that's been happening caused you to delay trying to go on offense with open banking? And I think banking as a service has been in sort of a similar situation where because there was this flight to quality, I think there were a lot of banks that maybe could benefit from or really do banking as a service well who stayed out of it or who got out of it or who just kind of paused. And that uncertainty, it's really good for incumbents that are well established, right? So in the banking as a service space, the Cross Rivers and Metabanks of the world, they have their scar tissue built up. They weren't going to get out of it. The uncertainty has actually been great for them because there's a flight to quality. We're one of the ones who can stick in this. We can take on more programs. But it was those kind of disruptors who are trying to get in the space who are sort of temporarily stopped. Same dynamic is happening in open banking. There's a lot of smaller banks that I think kind of implicitly took the message that, don't worry about open banking. We're just going to kill it. You don't even have to think about it. It's fine. And the reality was, Chase was never trying to kill open banking. Chase was trying to lock in the most favorable conditions for open banking so that it could take advantage of it. PNC is the same way, US Bank is the same way, Capital One, all of these big banks are going to use open banking. But the challenge is, if you're a smaller regional or community bank or credit union, you probably haven't spent nearly as much time or invested as many resources trying to make open banking work. And that's going to be a lot of catch-up that now has to happen because whatever the CFPB decides to do, open banking isn't going away, and banks need to go on offense with open banking. They can't just play defense or hope that Chase will play defense for them.
Yeah. And the final thing that I want to then sort of I want to know if you think that this thread makes sense.
Sure.
As well as the power dynamics and, however that may come about because of the regulators or because of just opportunities that appear and Chase being able to use its market power to push their power there. There is the data, bank data, is stored across a number of very, very old legacy systems.
Yeah.
And when I think about bank cores,
yeah,
that is the information that a lot of these banks are going to need to, execute their AI strategy, to enable open banking, to do all of this stuff that is frankly going to take them from where we are now, forward over the next 10 years.
To do ledgering so banking as a service doesn't get screwed up again.
Exactly.
Yes.
And so are we going to see something similar with the bank cores or the biggest, LOSs or the biggest choose your vendor category across the banking suite, where they realize that they have got the data, the thing that's needed, and they're going to just make it difficult for fintechs or frankly maybe even the banks themselves to access that data and use it for what they want to use it for?
Yeah, that's a great question. That's one of the reasons that smaller banks kind of object to open banking as a mandate is they're not technically ready to support it. So I think that is a very, very real challenge for a lot of banks. I think the reality is that what we're going to see is a lot more investment on the platforms that can ingest open banking data and a lot less on the platforms that output open banking data. And so if you think about the cores, they don't really have any, or the digital banking platforms out there, they don't really have any incredibly strong incentive to enable this, because enabling it doesn't magically create more money. Now, if Chase shares some of the revenue, or if that revenue in some senses trickles down, maybe, but I don't think that's going to happen. So I don't think there's really any monetary reason for any of the companies that support systems that output data to invest more in them. But what we are already seeing are a lot of the platforms that can ingest bank transaction data, modifying how they work, building new integrations, building new partnerships to ingest this data, because they know it is really, really valuable, right? So every loan origination system is adding cash flow underwriting and data aggregation as an input into their system. All the payment platforms are looking at how can we integrate open banking to make pay by bank more viable as an option for our customers. A lot of the fraud providers, I was just doing a panel here at Money 2020 where we were talking about how do you fight fraud in the age of synthetic AI-driven identities. And bank transaction data is actually a great fit for that, right? Because bank transaction data is highly authoritative because it comes from banks that are already KYCing their customers, and it has a great depth of history because, you know, if I had a checking account with the same bank for 20 years, you can't fake that overnight, right? Like that's actual inflows and outflows of money. So, you know, fraud providers are going to hook into this data. So I think we're going to see a lot of investment on the systems that can take this data in. The challenge for banks, and honestly for fintech companies too, depending on kind of how their systems are set up, is in addition to needing to connect to aggregators to get consumer permissioned bank transaction data, a lot of banks are terrible at using their own first-party data. And so I think a lot of the improvements we're going to see from banks that choose to make this an investment priority are going to be on, hey, like, we already have a bunch of on-us first-party deposit data. Let's go get that, use that before we ask any customers to bring data from other institutions. Let's start there with our own first-party data. And again, the Chases of the world are years and years ahead of other banks on this, and so that's where a lot of the investment, a lot of the catch-up needs to happen.
Yeah, and that will be a race against time to see if these smaller banks can do that before they may be bought up and the world is changing so fast. I think that's going to speed up.
That's exactly right. Yeah, when it's similar to banking as a service, right, where it's like, you know, are you going to be on the M&A treadmill, or do you have some other path to relevancy and you know, sustainability? And I think that open banking honestly can provide another one of those paths. You know, I mean, I think there's just a lot of ways to bank better if you use this data to go on offense. And so I think there will be a few banks, including smaller ones, not just the Chases of the world, who figure that out and who really benefit from open banking. And that's what I'm hoping to see.
Yeah, awesome. Well, thank you, Alex, so much for chatting with us. And that's it for another Tasha's Takes.
Thank you.